All right, we're going to stick with tech and go hunting for opportunities in that beaten down sector. Joining us right now, Paul Meeks, portfolio manager at Independent Solutions Wealth Management, along with our own Deirdre Bosa. Thanks, both of you, for being here right now.
Good to see you.
So, Deirdre, I'm going to start with you. I mean, we're looking at tech, but tech's a broad term. You have high growth tech and you have mega cap tech. How are each one of these performing right now as we see this sell off?
Well, simply put, very differently, mega caps have been holding up better all year, and that's been the same over the last few weeks, too, with this leg down as we get close to those June lows. And that is really propping up the broader market from even more losses. I mean, a name like Apple makes up more than 7% of the S&P 500, and it's actually a relative outperformer this year, even compared to the other mega caps. So if it can stay strong, maybe losses can be limited. However, you could see some cracks emerge. Frank, we're going to be looking at cloud growth from the likes of Microsoft, Amazon, and Alphabet this year. You asked about unprofitable tech as well, and these are some of the worst names this year. Names like Zoom, Datadog, DocuSign, the darlings of the pandemic. We know very well that they've been hurt this year. They're hurt by rising interest rate. That continues. And the question for investors is, now they look cheaper, but do they look cheap? And that's what I think everyone's trying to figure out here.
Yeah, a lot of valuations cut. Paul, over to you. You actually have some picks for us. You have some picks on semi in the chip sector, something Christina covers. Also, Harmonic and Palo Alto, a cybersecurity stock. I want to start with Palo Alto. Is cybersecurity one of those places that investors can hide? We're hearing so much commentary about the need for cybersecurity as part of this cloud transition.
So unfortunately, you're never going to be able to hide completely. But I do think within the tech sector, yes, that is a focal area. Yes, it will continue to grow, relatively speaking, much more quickly than the rest of the sector. Now, Palo Alto Networks versus my other two picks is actually a rather expensive stock. But this one, I feel very comfortable that will continue to not only make the numbers, but beat the numbers. And you can't say that about too many tech names.
All right, we just covered chips a minute ago, Paul, but let's just talk about your other pick, Harmonic, in the server and router space. If we're facing some type of recession or downturn, does this business remain strong?
Harmonic's interesting because it's video and cable access gear and more software, which brings with it increasing margins. And so here is a rare story where, regardless of recession conditions, we'll see the top line grow this year and next 20%, with margin expansion, earnings per share growing 40%. And even though the stock has done very well this year, it's down 6% versus down almost 60% for something like the big boy in the space, NVIDIA. The stock is still only trading at 15 times earnings, which is even less than the S&P 500's multiple.
So, Deirdre, back over to you. We talked about high growth tech a second ago, but it's not all created equal. One of the areas that you cover is rideshare, and other consumer facing tech, and also food delivery. Where does that go from here right now as we face potential recession and also some of their costs going up because the labor market is still overheated?
Well, these names are largely included in that unprofitable tech business. However, they have a little bit of a different edge because they're not strictly software companies. And the likes of Uber and Lyft are part of this reopening play. As you see more conferences, especially here in San Francisco, they're seen as beneficiaries. However, their valuations have been beaten down as well. And it's the same question. Where should they be valued? Are these still tech companies even? That is something that we've been asking for ages, basically since their IPOs. Another interesting thing, though, because we have talked to a bunch of CEOs in this space over the last few weeks, like Brian Chesky of Airbnb, Dara Khosrowshahi of Uber, Tony Xu of DoorDash. They say that the consumer remains resilient. So you have seen these names hold up a little bit better, but again, there's still these sort of growth, unprofitable tech names. And that's also important, of course, for where the Fed is going to go, where the economy is going to go. The consumer, to them, right, at least the data they track, remains resilient. The Fed may want to see more pain.
So, Deirdre, you've done so much coverage of this high-growth stock. A lot of people are going to ask, with valuations really slashed, is this the time to jump in? Is this possibly the time to buy the dip?
You know what? We've been having this discussion a lot on air on Tech Check, and I guess my takeaway from a lot of the folks we'd be talking to, people with skin in the game, investors, they say look for your industry leaders. Those are the ones that are going to sort of emerge from this recession, the ones that have been through this before, like a Microsoft or a Salesforce. Companies that are sitting on cash as well. So they can actually be offensive when a lot of tech has to be defensive, preserve cash, make cost cuts. So maybe that's where you look. But again, those industry leaders, you see some of those in cyber security as well, that have fared a little better.
All right. Speaking of things coming back to in-person, Dreamforce out there in the Bay, it was pretty hard to find a Lyft or an Uber out there. All right, Deirdre and Paul, thank you very much. Thanks for being here.